Hello, this is Steve Malone with Compass FX. I hope you're doing well today and you getting some good trades. Today we saw the largest one-day inverse correlation between a commodity-based currency pair and the commodity itself. That was the dollar CAD and crude oil. Now these two move in opposite directions. As crude is moving to the downside, the dollar CAD moves up. And why is that? Because about 50% of the export and income for Canada is made up of its natural resource of oil. So as crude oil is slipping lower overall, then we're looking for additional weakness in the Canadian dollar. And given that, also today we had strength in the US dollar. So US dollar strength, Canadian weakness due to a slide in crude oil, we see this move up, breaking beyond the 113 barriers. Now take a look at crude, meaning the marketplace are looking for crude to make a continual move down. But let's focus in on what took place today. OPEC came out today and made the announcement that it was unlikely to cut production in response to lower forecast demand. Some in the marketplace are suggesting that there's a bit of an oil glut in the market. This would cause then oil prices to slip and fall lower. Where to? Many are looking for the possibility of the market to push all the way down to 75, something we haven't seen. You have to go back to about August or October of 2011 to see the market push down to about that 75 level. And there's a lot of levels to get to before we get there, especially the 80 level, which should be some sort of settling in what the market's doing right now. But let's take a look at what's taken place again today and what my expectations are. If you take a look at crude has already made a bit of a bounce back up. So if we consider a Fibonacci retracement from the high to the low of the day, we can see that the market is pushed back, and currently at the time of this video we're sitting at about a 23.6. If the market pushes back to 38.2 or 50%, then we're looking for standard profit taking, a possible then a reset in the marketplace, and some are expecting the market to push up to that level. However, on the flip side, those in the marketplace who are more bearish in crude oil are looking from the standpoint that if the market doesn't get any higher and doesn't touch the 38.2 or close at it, that is a bearish signal. If the market holds around the 23.6, and that's all we really do, this little up and down right here, that's all we really do, then that is a sign of continuation. And then we'll get the push down, and many are expecting that that push will come somewhere in the ballpark of about the 80 level, which is right about a psychological level. Now, how will that impact the dollar CAD? Well, if the market pulls back further in the crude, then what we'll look for in the dollar CAD is a possible pushback to about that level, somewhere I'd say in the ballpark of about the 1250, 1255 area, if crude continues to push back. However, on the flip side, if crude holds this area, rolls down, and continues in the Asian session and into European session overnight, then I'm going to look for the dollar CAD to push higher. Where to? We go from today's high to today's low, and we just run our fibs, and I would suspect that there's the possibility of the dollar CAD to push up to about 1346, 1364, right in that area is a high probability area, eventually up to about the 1390 area if crude does push all the way down to that 80 area. Now, like I said, there is that bigger picture on the monthly aspect of crude. And where do we go from a monthly perspective? Well, if you look at this on that monthly chart, you can see that going back to about June of 2012, we have this level of 77.35. That low, that's what the market's looking for to some degree, but more so the market's looking at the 75 level that goes back to October 2011. You can see it's right in the middle of this range that we had going back to 2009. So bears in the oil market are looking for that push all the way down to that 75 level. That could drive the Canadian dollar up back towards the 120 level. But before we get to 120, let me step out to show you that there is a level that we're going to have to get to and see how the market reacts at that. And that is at the 1720 mark. 1720 came in June 2009. So the market will have to get up there, test that level. If we get above that level, then the 120 will come in. And I think that 120 then is going to be somewhere along being the 75 level in crude. So look for that continuation. But again, with that big move down today that we've had in crude, look for a bounce back up. Look for the market to become a little bit more stable and steady, a push back up, some possible profit taking from that, and then possible continuation down. However, if the dollar continues to strengthen in the marketplace and OPEC doesn't make any decisions about changing their production, and there's consensus in the marketplace to see a push lower in crude, then look for that. Look for that move down to 80. And again, for those of y'all trading the dollar CAD, as I mentioned, go back down to that hourly chart, run your fibs from top to bottom, and look for that push up to about that 1350, the 1365 area, and possibly all the way up to 1389. Well, this is Dean Malone with Compass FX. Hope some of this information will help you as you trade this marketplace. Y'all take care. Have a good day. We'll talk to you next time. Bye-bye.